A very good evening, everybody. Welcome to the webinar, Trading the Singapore Index in 2020. I'm Ming Hui from Affiliate Futures, and speaking to us today will be Geoff Howie from SGX. Geoff is a market strategist at SGX with more than 20 years of experience in financial markets and economics. Tonight, we'll be taking a closer look at SiMSCI's performance so far in 2020, as well as how the first half of the year has impacted its tradability. Before I pass this on to Geoff, I'd just like to inform you that if you have any questions throughout the course of the webinar, please feel free to drop them into the questions box as we will have a Q&A session towards the end. And now, without further ado, let's have Geoff speak to us.
Good evening. Hui Cha, can I just check, can you hear me fine?
Yep, you're good.
Okay, great. I will proceed. Well, thank you, and a very good evening to you. The presentation tonight, as Hui Cha noted, it will be the Trading the Singapore Index in 2020, and it will run for around 45 minutes with some time for Q&A at 7:45. So the objective really is threefold. It's to provide you with an overview of the solid foundations of our Singapore indices, take a look at the application of Singapore index hedging in the 2020 year, as well as take a look at the application of some spread trading opportunities using Singapore index futures as well as other index futures over the past 12 months or so. So I must point out, of course, this is an educational presentation. It's designed to be purely informative on the traits of an index, and with obviously recent observations of that index. It's no way providing investment advice. As you would know, all these futures contracts are specified investment products and for sophisticated investors only. So what I want to do is start off with the basic, just rewind the clock and look at the big bang of Singapore indices. Indices and investment flows into indices are so important across the world. And even the IMF has noted that capital flows that go into following index benchmarks across the world can account for more inward flows and outward flows into an economy than the actual balance of payments can. So these have become huge in recent years, and that's really the evolution of the stock market as a whole. Globally, there's some $90 trillion of GDP across the world, that's US dollars. And at the same time, there's just under $90 trillion US dollars of market capitalization across the global stock market. So stock market investing across the world, it's obviously a very important aspect of these indices. Now, for us in Singapore, our Straits Times Index, if you will, it started in 1967 on the first of that year, first trading session of 1967. So our base date for the STI that we commonly quote and cite is actually a 100 value back on the 30th of December 1966. That's the Straits Times Industrial Ordinary Share Index. That's where we had our start. 5 years on from that, that base date of 100 on the 30th of December 1966, Singapore was already well into its export promotion phase. And we saw that Straits Times Index basically double, reaching 200 within a 5-year period. And many of you would know more about the industrialization of Singapore than I would. I've only been here for, I think this is my 11th year in Singapore. So I won't go into more of that. But suffice to say is this dark blue line that you see in the chart, it represents not the Straits Times Index, but the MSCI Singapore Index, the basis for the SiMSCI futures. That's represented by the dark blue line. That index itself was launched sometime later in at the end of March 1986. So that's the evolution of the MSCI Singapore Index, if you will. Now importantly, and this is an important implication for futures traders, we have had two major revamps in the Straits Times Index in its history. The first was back in August 1988, and that's when this original Straits Times Industrial Ordinary Index was basically became, the Straits Times Industrial, or the Straits Times Index itself, with 55 component stocks. that basically occurred at this point here. And then the second major revamp of the Straits Times Index was in January 2008, and that saw the then 47 component stocks in the STI cut to just 30 STI stocks, and it's been that way ever since. So we had those two major revamps in 98 as well as 08. Now, the implication for the futures traders is big because basically we saw the correlation of the MSCI Singapore Index and the Straits Times Index enhanced significantly with those two major revamps. You can see in the early days from 1986 through 1998, correlation wasn't that high. It was 0.76, and that's still high, but it's not statistically significant. It became statistically significant in the first revamp and got better and better, and has been consistently around 0.98, with one being the highest, 1.0 being the highest correlation. So that's a bit of a history there in terms of the two indices and how they are very important. I might also mention and just digress for a second, just for the benefit of listeners and viewers, that so far this year we've seen the STI basically fall around 35% from its pre-cycle high, I guess, going back to 29th of April 2019. At this point here, this major high here, down to that low of 2208 on the 23rd of March, that was an exact 35% decline. Now, that's significantly less than what we saw in the global financial crisis. In the global financial crisis, we saw the major high of the green line, which is the STI, the major high of this green line was at 3906 on the 11th of October 07, and then fell to that low in the STI of 1457 on the 5th of March. So that represented a 63% decline, much less than this 35% decline. Subsequently, the STI then recovered 127% up to the 9th of November 2010. What I should go back to as well is the SARS period. That's you can see this here, this actual V shape that we saw, where we saw in the SARS time, we saw the actual decline of the market from the major high on the 5th of March 02 down to the low on the 11th of March 03. That was also a 35% decline for the STI. So the STI decline we've seen this year from high to low is very much like we saw in the case of SARS back in 03. However, we have not seen that quick recovery. We saw an evenly paced recovery back from the 11th of March 02 up to these early 2004 highs, a 59% recovery there. So obviously the recovery's been a little bit more anemic, particularly here, maybe less so in the United States, but obviously much of where we are right now at this juncture does depend on the US being able to avert a second wave of the coronavirus. And we can talk more about that and the implications of the market trends and stabilities, what we observed in the past at the end of the presentation. But for the moment, I would like to have more of a focus on introducing this product, if you will, or reintroducing it from a perspective of a person that's been a futures broker all their life, up till joining the SGX, and then focusing on the stock market for the last 10 years in Singapore Exchange. So I might hopefully be able to share some interesting facts on this index and foundations on this index that might actually be something you can take away from this presentation. But look, the primary aim of all these indices is to reflect the trading activity of our listed stocks here in Singapore, and therefore to really reflect the performance of our local economy, particularly the earnings of the major listed firms. We always have our earnings seasons, as you would know. They've traditionally been on a quarterly basis. They're looking more to be more on a semi-annual basis, but we always know going into that earnings report, we always get our advanced GDP estimate for the past quarter. And that's always, basically the precursor or the bellwether for what we expect in the earnings for that next period. And that, I guess that preemptive earnings number is always based on the first 2 months of the month that it's reporting. What we've got to show you here is the blue line represented by the SiMSCI, the MSCI Singapore Index, and the green line representing Singapore's year-on-year GDP growth. So there are obviously many synergies with the Singapore economy and its stock market, okay? I mean, just as we know Singapore makes up 0.4% of the world's GDP pie, just 0.4%. But our stocks here in Singapore, especially the MSCI Singapore, make up around 0.4% of the world's GDP pie as well. And there's so many similar synergies, even in manufacturing. Manufacturing, as you know, makes up a quarter of our economy here in Singapore. If you look at the top 50 stocks by turnover here in Singapore, 1/4 of those stocks are also focused on manufacturing activity. And what we've got is, as we said, this blue line representing the index, the green line representing year-on-year GDP growth. What we've got is a historical directional correlation between the price performance of the SiMSCI and Singapore's GDP as shown in the top chart. It's not a strong correlation statistically, it's just a simple directional correlation. As you can see, the recent decline in GDP has also coincided with a decline in the MSCI Singapore Index as well. And obviously you would know we are expecting to enter a recession this year, of course, and the MAS latest forecast is for growth to decline this year, somewhere between 0.7% and -0.4%. In terms of key asset correlations as well, it's important to point out that over the past 5 years, the MSCI Singapore Index has maintained a 70% correlation, or a 75% correlation, I should say, with the price of crude oil. And I guess the correlation with that crude oil, it's exemplified here at this point here. You can see through to the end of 2014, the MSCI Singapore held up pretty well with the price of crude oil, while GDP was actually falling here in Singapore. So in many ways, crude oil is also a very key, important price asset class with a correlation to our market. In this case, did hold the SiMSCI up while GDP was falling in this instance. We also saw that repeated somewhat recently in last year, in the back end of 2019, with oil prices basically having an impact on our indices while GDP was getting lower and lower. But just on these commodities, I should also mention one more commodity class is gold, and that's where we do have a very low correlation. Basically, the correlation of the gold futures or the gold index or the gold ETFs, whichever way you look at it, it has a minimal 6%, close to 5% correlation with gold. And that's why gold is actually used as an important portfolio diversifier. The World Gold Council do suggest when you are adding risky investments to your portfolio, gold should make up somewhere between 2% and 10% of the portfolio. Case in point is, if investors, when they started the year, if they were using the SiMSCI futures as an investment medium and they put 50% of their money management said 50% of the money goes into the SiMSCI, 50% of the money goes into maybe gold futures or a gold ETF, then as of this point right now, the return on that portfolio would have been something like down 0.5%, not including transaction costs. So gold has been almost a perfect hedge to the Singapore Index that we've seen in the year to date. But moving right along, what I've done here is I'm assuming we do have some MSCI Singapore futures traders with us. There's a link there that you should try and copy because that link will take you to the actual constituents of the index, as well as show you the weightings and the sector breakdown as well. I will, of course, make the slides as much as I can of the slides available to the team at Phillip Capital, and they can obviously pass this on in these links and so forth. Otherwise, any material that you need or further detail, please don't hesitate to reach out reach out to me. I'm more than happy to talk with you over email or over the phone call, anything you need whatsoever, if you need further information. But I'm just showing you how this works. Now, this index is very much like a typical Asian index, with banks and real estate making up the key cornerstone sectors. Very different to the S&P 500. The S&P 500 is 3,100 thereabouts. But if you look at the sectors of the S&P 500, 40% of the weightings are two key sectors of technology and healthcare, which together have been quite defensive in the 2020 year to date. By comparison, here in Singapore, our two biggest sectors are actually financials, which are the banks, and real estate, and then industrial somewhat as well. This MSCI Singapore Index, as we say, it's very highly correlated to the Straits Times Index. The correlation has grown over time. It's now at 9.98. A correlation of 1.0 would be the absolute highest possible, so it is very high. But the MSCI Singapore, what it includes is 22 stocks, not 30 stocks that the STI includes. So it's only 22, of which 21 are mutual constituents of the Straits Times Index. The one stock that is not part of the Straits Times Index that is included in the MSCI Singapore is Suntec REIT. So I should also mention that why I've got the two donut charts is because we did have a rebalance recently on the 29th of May. So twice a year, MSCI will have big rebalancing that does have an implication on the stock market here. You might have noticed there's been a couple of occasions where we've seen very strong turnover on the close of our local market, and in those instances, you do have index rebalancing. You have it on the FTSE, which do it on a quarterly basis. You have it on MSCI, which do it more on a semi-annual basis. And one of those days was just recently back on Friday. On Friday, we saw Mapletree Logistics Trust added to the MSCI Singapore, while three stocks, Comfort Delgro, SATS, actually not three stocks, four stocks, Comfort Delgro, SATS, Singapore Press Holding, and Sembcorp Industries were removed from the index. I might also mention for our traders here who also follow the STI, we had an STI rebalance today, and we saw Mapletree Industrial Trust join the STI, and we saw Singapore Press Holdings leave the STI. Singapore Press Holdings has left the STI, I would say predominantly because they had a spin-off back in 2013. Remember, SBH REIT came out of SBH. So if you had SBH REIT that was still part of SBH, obviously it would not have come out of the STI. Would have been well into the market cap threshold to stay in the STI. Okay, so you can see how this is made up. IT, very small. Venture Corp, 2%. Consumer discretionary and consumer staples, quite small as well. Communication services, quite small. So this index, it doesn't have a very high amount of defensive sectors in there. Most of these are cyclical, and for that reason, this MSCI Singapore index does tend to move around and swing around like the STI and like our GDP and so forth. So I should move straight along into SiMSCI Futures and just take this opportunity to have a little bit of this is my sell to you in terms of what our best, attributes of the index that we can sum up for you in a few minutes. Basically we all know what futures are, right? Index futures, they are derivatives. They derive their value from a pre-existing security, such as, in this case, a security index. And of course, the MSCI Singapore Index Futures are based on this MSCI Singapore Index. Okay, so the three key benefits, you've got the synthetic equity position. It allows investors to quickly take advantage of both event-driven news and long-term economic trends of the broad stock market in a very fast and cost-efficient way with a single transaction, with the caveat that you do have to roll that position every single month if you go and invest in the current position. I should also mention that if you are building a synthetic equity position, there's two key differences between buying the actual stocks and buying the index futures. The first is if you own the index futures, you don't receive the dividends. And Singapore because a lot of these companies are net cash positive. A lot of the companies have, we've seen the real estate investment trusts having more of an impact in the indices. We have the best or the highest or the strongest dividend yields across Asia Pacific. So for that reason, you can see quite a bit of a discrepancy between the price of the SiMSCI futures and the actual SiMSCI index. Because the SiMSCI futures don't actually get the dividends, they should be priced a little bit cheaper. They should be a little bit less expensive to the investor. Hence, that's why SiMSCI futures can trade at a discount to the underlying SiMSCI index. But on the other hand, you've got a very small initial margin, or not very small, I guess $2,000, but that's comparatively smaller than the notional value of the contract, which could be, say, $30,000. So that remaining $28,000 that's not being utilized could be in a bank account earning some interest, assuming it's not in Europe and earning negative interest. There could be more use for that money. You could be putting that into another yielding product that Philip can work out with you. So that's we've just lost. I don't know what's happening here. Sorry. So that's a quick. So I don't know what's happening. From current slide. Resume slide. Okay. So that's the key point, the synthetic equity position, and I also wanted to point out the cost of carry, the pricing, how index futures are priced. Basically, the index futures equals the MSCI Singapore Index minus the dividends plus any risk-free interest rate impact. Okay. The second is that leveraged exposure. Trading these indices, as we say, requires that initial margin deposit that represents just a small fraction. Now, that's very different to trading many of the structured derivative products out there, very different to trading ETFs and so forth. That cheap and leveraged beta exposure is the second key point. The third is flexibility. You can apply so many different trading strategies, from portfolio hedging to taking directional positions, intraday trading, index arbitrage, and also mean reversion and pairs trading, which I'll show a few examples on trading the MSCI Singapore versus the Nifty futures and so forth. But it's been obviously a very eventful year, and we've seen the volume increase significantly on these futures contracts as well. Just for the first 4 months of this year, the volume of the SiMSCI futures was up almost 40% from the same period as last year. And importantly too, we've got a market that does trade around 22 hours a day. I'll show you on this chart. I've got the basic contract specs, which I just took off the screen before we started tonight. So a couple of things from here. We've got our time. So the day session opens at 8:30 in the morning, finishes at 17:25 here. Actually, I've got 17:20, so I'm not sure why Bloomberg's saying that. It's probably the closing procedure. Then we've got electronic market at 5:40 through to 5:15. Okay. So we're taking all the hours in there. For the trading times, it's 8:30 to 5:20. The T+1 is 5:50 p.m. to 5:15 a.m. the next day. Also, liquidity. I should just take a point to note that the index, if it's trading at 300, the standardized contract multiplier of 100 Singapore dollars means the entire contract value, or the notional value of the contract, is $30,000. And then the minimum tick size is 0.05. So the minimum move would be from 300.00 to 300.05, or 300.00 to 299.95. So obviously, if you're taking a long position because you anticipate prices to rise, you would be buying at let's say 300. If the contract moves to 300.05, you would be making a $5 Singapore return. If you had the long position, but the index moved from 300 down to 299.95, you would be taking a $5 loss. But if you were short and taking the short position at 300 and then buying it back, let's say at 299.95, you would be making a $5 gain. Obviously not including the transaction costs. So just to reiterate, in case there's anyone new to the index, I wanted to make that point. Price limits are also really important. It's plus or minus 10% from the previous day's settlement price, and then plus or minus 15%, which has a 5-minute cooling off period, and then no other price limits for the rest of the day. But of course, on the expiring contract, on its last trading day, there are no price limits. Moving on to the forwards in the months, I should point out that the contract has trades with 2 serial months as well as 4 quarterly months. So at the moment, we've got the June and July, and then we've got September, Dec, and March as well. So we should have 2 serial, which would be the July and August, and 4 quarterlies, which we do, which are the June, September, December, and March. I would like to draw your attention to this August 20. See this August 20 contract, this forward contract had a settlement price of 304.55. You can see that the prices generally get lower as you go out into the future, but you can see the pricing of this one is a little bit out because you've got 09, 08, 04 here. You'd think this should be maybe around 306 if it was congruent with the pricing trend. The reason being is because August is a big month for dividends, and I made that point before that if you don't receive dividends with SiMSCI futures, hence because you don't receive the dividends, it should be priced a little bit cheaper. And there's 2 months of the year that the MSCI Singapore have a lot of heavy ex-dividend dates, if you will, a lot of dividend distributions, and that's always in May and it's always in August. Hence, you can see that August is priced, pretty much at the same price as September, but maybe, having a pricing impact from the dividends there. Just to show you some of the liquidity, because we did talk about some of the moves. Obviously, in the month of March, we saw significant volatility in our market, and that's when we saw the turnover on the MSCI Singapore really pick up. A lot of prop traders were busy with intraday trades. There were a lot of hedging activity going on in the month of March when these indexes plummeted to those lows, which in the case of Singapore, we've seen 20% recovery from since. We also saw, the open interest somewhat come off a little bit through the months, but sustained somewhat over the last 3 or 4 months. Key point too is to note that this is a liquid contract in terms of our futures markets. It's in our top 5. So obviously we have our Nikkei 225, we have the A50, we have the Nifty, we have the MSCI Taiwan, we have the MSCI Singapore as our 5 most liquid futures contracts. We've also, the bid and offer spread, I should also mention as well, was quite consistent, and generally around 1 to 2 ticks in the month of March. So I guess the bringing together of all the prop traders and the hedging activities and the asset managers in the bank basically did see much of the liquidity in our market in March really pick up from January to February, and we also saw that in the T+1 session as well. Significant trading, sometimes 20% of our daily turnover we were seeing happening in the T+1 session, but typically T+1 session would be around 8% to 20% of the day-to-day volume. I guess in terms of size value, notional size value, you got the bid, you've got your offer, you've got the bid size and your offer size. when you look at the average, I guess the average value between the bid and the offer at any given point of time during our day, in the Asian time zone, is typically around 300,000 Singapore dollars. So, I've got a few examples here of trading. The first is this hedge, basically looking at going into 2020 with a short position on the actual SiMSCI futures and how it would have protected positions in the underlying stock market. So for the chart, obviously you can see again that very strong relationship between the Straits Times Index, represented by the dark blue line, and the SiMSCI futures, represented by the green line. It's again, I should make that point. This is a long-term holding of a trade. Okay, this position is being held over 4 or 5 months. So I do have to reiterate those important points of the futures market, that they are leveraged, and secondly, they do all have expiry dates. So that makes them obviously more suited to sophisticated investors. Now, for the leverage, on the 31st December, if the trader took one position in the January SiMSCI futures at the price of 371.5, multiplied by the standardized contract multiplier of $100, the notional value of that position would have been $37,500. Now, for the leverage at that time, the initial margin or the deposit requirement, say it's $2,090. So for $2,090, you've got the exposure of a $37,500 share portfolio. You've got exposure to the adverse movements of that portfolio. You've got exposure to the beneficial movements of that portfolio. Hence, investors should know and should always note that they can lose more than their initial deposit when trading futures. And secondly, that other thing that we do trade, for this example, on a monthly sequential basis. So if a short position was taken in the SiMSCI futures and held all the way down here to the 21st of May, there would have been 4 different instances that the futures position would have to be rolled, from January to February, from February to March, March to April, and April to May. And this can obviously add to the transaction cost, particularly if the front month is trading at a premium to the forward month. Because if you're trading at a premium to the forward month, remember you've got to buy back the short position in the front month and then sell again in the forward month. Hence, you would ideally have the forward month priced higher than the front month. So there is a cost if the front month is trading at a premium to the forward month. And for instance, back in April, in this point, back on, let's say, 10 a.m. on the 29th of April, the April contract was at 29.46, and the May contract was at 29.2.4. So the investor would have to close out the April, buy the April at 294.6, sell the May at 292.4 for a 2.2 cost, or representing 0.7% cost. And then back on March, when you're holding the short position into the March expiry, the March contract's at 277.45. You have to buy that back at 277.5. At the same time, simultaneously sell the April contract at 276.85, and that's a 0.6 point cost loss, or $60 Singapore, or 0.2% of the overall notional value. So that's one point to take out. And typically positions wouldn't be held so long, but to illustrate this hedging application, I do want to show this in terms of some of the asset managers that use these futures contracts for this particular purpose. So in this example, the futures hedge would have seen one January SiMSCI futures sold at 371.5 and bought back at 294.65, and closed out at 294.65. Hence, the basic difference is the notional value difference, 37,500 minus 29,465. On that 37,500, it represents a 21% return on the short position, not including transaction fees and rolling costs. So you can see that the 21% return has been made on the MSCI Singapore Index Futures, the short positions, not including these costs. So you know, it could be 1 or 2% as well. But you can see the majority of the position of the STI has basically been protected. Much of that exposure was protected using the SiMSCI futures in the year to date. Okay, so I'll move on to, we've got 10 minutes or so, and I'd like to spend the last 10 minutes or so just looking at some, I guess, a little bit more, you know, a little bit more interesting in terms of the application of these futures contracts, and look at pairs trading or spread trading opportunities. First is let's look at the SiMSCI and the Nifty futures. So I'm just going to skip ahead to this chart here. It's always seen here, just to draw your attention to this white line. That's the SiMSCI futures, and the orange line is the Nifty futures. And they start at the same point because this is a normalized chart. But you can see over this period of time, SiMSCI has outperformed Nifty. Not by much, but it has somewhat. Okay, the price ratio, looking at the price of the SiMSCI to the Nifty, should rise over that time, which it has, because Nifty goes higher. SiMSCI might go higher, Nifty goes less higher. The price of the SiMSCI gets higher, or higher, more comparatively higher than Nifty, and the price ratio of SiMSCI to Nifty should obviously increase. So this is the period of time that we're looking at. So we go back to the 14th of June. So you can see on the 14th of June here, you've had the MSCI Singapore futures, represented by the white line, rise over this period, but some period of time Nifty has outperformed and outpaced. So there's quite a bit of divide, particularly over the recent 3 years. You can see over that 3-year period, Nifty has outperformed here with a 46% gain versus SiMSCI an 18% gain. Now, looking over that 3-year period, this difference, or this price ratio of the SiMSCI to the Nifty has been stretched. It's down at this point here, much relatively lower than where we once were. In fact, if you look at where the price ratio is now compared to where the mean price ratio is over those 3 years, we're actually just been here 2 standard deviations below the mean. So 2 standard deviations. 1 standard deviation would mean if you're within 1 standard deviation of the mean, that should occur 65% of the time. If you're within 2 standard deviations of the mean, the rules of standard deviation mean that would happen. You'd be in that zone 95% of the time. But 5% of the time, you can be outside of the standard deviation, 2 standard deviations from the mean. Now, if that moves back up above 2 standard deviations of the mean, as it did on the 14th of June, that could have been a signal to an investor who thought that the SiMSCI would now start to outperform the Nifty. That could have been a signal to buy Nifty and sell India. Now, you're basically focusing the trade on the price performance or the difference. You think SiMSCI is going to outpace the Nifty for the foreseeable future, which is why you would do that trade. And you take out quite a bit of macro risk per se. If there's big things in the world that can happen that can impact both indices, in a way you're kind of hedging that out because you're just specifically focused on the different performances of these 2 indices. So we saw that price ratio move from below 2 standard deviations to above 2 standard deviations. Now, assuming you wanted to get the full margin offset that we offer at SGX in terms of the risk management rules, that if you are taking opposite positions in 2 indices and you want to get the full margin credit provided, we've got those delta ratios that we do publish on the website. Now, assuming at that time you wanted to get the full 46% initial margin credit, that being the case, when you take the position in the SiMSCI, the opposite position in the Nifty, you add the initial margins up together, you only have to pay 54% of it if you do it in line with the delta ratio that we've got here. And this full delta ratio at this point, it was 17 SiMSCI indices, it was 20 Nifty 50 index futures. So you buy 17 SiMSCI index futures at 360.4, notional value $612,000. It's a lot, with initial margins of $22,440. But at the same time, you sell the 20 Nifty 50 index futures for a notional value of $477. Remember the contract multiplier for the SiMSCI, it's 100. So it's just basically 17 times 100 times 360.4 equals 612, 100,000. For the Nifty, it's 20 times 925.5 multiplied by the index multiplier, which is $2 US. So that notional value is $477,000 US dollars. So initial margins were there, but you would have received, as we said, a 46% margin credit. So you would only have to pay 54% of that margin had you applied it at that time with that ratio. Now, going right ahead, so moving from when we took this position in June 2019 through to when we closed the position amidst the sell-off, the indiscriminate selling that we saw on the 23rd of March. We closed on the 24th of March because, look, basically that if you're trading the mean reversion, we've gone from below 2 standard deviations to above 2 standard deviations when the position was taken, and we've returned to the mean at this point here. So we've seen, if you will, Nifty come off somewhat and Singapore outperform as we expected. So what do? We bought the SiMSCI index. We now sell those positions, and we take a loss. So the SiMSCI didn't actually gain, it did decline. We take a loss of $151,000, but the Nifty, we sold that, and what we saw the Nifty actually fall more than the SiMSCI. The Nifty, those 20 contracts are now at 7884. They were at 11,9255. They're now here. So the notional value of that has fallen significantly. So that represents a return of 234,000 Singapore dollars. So had we applied this mean reversion trade over a significant amount of time, mind you, you would have been paying roll costs all this time, but nonetheless the return would have been around 80,000 Singapore dollars to hold this position. Now, in reality, many of us won't trade to that size, particularly when you're starting off. So I've got just one more example, which is a lot more recent, and this will be my last example before we finish off. And this is just basically in the month of May. So we apply that that methodology. Here we're back in a similar instance. So this chart, it's a daily chart, and here we are on the 30th of April. We've got the white line representing the SiMSCI futures. We've got the orange line representing the Nifty index. Now, we don't do the delta hedge ratio, the full delta hedge ratio. We just buy one SiMSCI, we sell one Nifty. It's a similar notional value. 17 and 20 is not too different to 1 and 1. Now, we won't receive the full 54% margin offset. The full 46% margin credit, and hence pay the 54%. We won't receive the full 46% credit, but we will receive some credit. Okay? There will be some offset received. Now, what we do in the trade, we buy the SiMSCI at 298.2. Notional value is obviously just 100 Sing dollars multiplied by that, $29,820. And we sell the Nifty index at 9785 for a notional value of around $19,570. Why do we do that? Because we've also seen, looking at this at a much shorter term time frame, not a 3-year history, but just looking at the last 6 weeks. Over the last 6 weeks, we can see the excuse me. We can see that this ratio has just moved above the 2 standard deviations. So it could be reverting back from beyond 2 standard deviations back towards the mean. It could be, it might not be, but if we do think it is, this would have been the positioning we would have taken. Then on the 19th of May, just a few weeks ago, you can see what's happened. So this is where we took the position. This is where we look to exit the position. You can see the price ratio of the SiMSCI to the Nifty has risen. So if we're buying SiMSCI and selling Nifty, we do think, of course, that the SiMSCI over the Nifty price ratio will rise. And it has. Look, on a 6-week basis, we've gone from one side of the curve, beyond 2 standard deviations, below to 2 standard deviations above. So it's had a full move, and we haven't seen that much move. What I'll show you is that, so we bought the SiMSCI at 298.2. We're now selling it at 296.45, a marginal loss of $175. Okay, but at the same time, remember we sold Nifty 9785. We're now buying Nifty back at 8824. So both contracts fell. The major difference is Nifty fell more than SiMSCI and we did believe that SiMSCI would outperform Nifty, which it did. So what you've got is a loss of $175 on the SiMSCI leg, but you've made a gain of 2,700 Singapore dollars on the Nifty leg. So sorry, you've made a loss of 175 on the SiMSCI leg and made a gain of $2,700 on the Nifty leg. So that's $2,525, not including transaction costs. There was no roll because back at the end of April, we would have been trading the May contract, and over the 2-3 weeks, we've held the May contract and closed the position out before the end of the May. So there's no roll costs. And a lot of index mean reversions. This is the more practical way of doing it. The first example I showed you was a little bit more theoretical, showing the exact delta hedging ratios with the position sizes, and it was also over a long period of time, just to show you, to really draw out, I guess, how contracts and these indices can move very differently to each other. So there's a practical example there. So I just, before we go into Q&A, I'll sum up. I mean, the point of this was just to give you an overview of how significantly rich our history is of our Singapore indices, how important the MSCI Singapore Index is to our Singapore market. We will obviously be continuing. We have a really, really very fruitful and strong relationship with MSCI Singapore. You know, I was a broker in the late 90s in Sydney. Is where I made my start at Jardine Fleming. And I remember in 1999 when I first started trading MSCI Singapore, or as a sales trader, basically executing for my customers. And it was a small fund, and they were trading the MSCI Singapore back in this is back in late 99. So I would call through to Cargill on the SiMSCI floor there, and it was it was a very popular contract back then. But I guess the key difference back then and now is that the futures market here in Singapore has grown significantly to a critical mass. And that growth means that we can also explore new opportunities for indices. So, as far as talking about moving away from those MSCI contracts, obviously the MSCI Singapore is really important and we maintain that. But we've also got the opportunity now, based on the significant growth we've seen in our derivatives market, to also look at new indices and new index providers and new products, such as the single share futures that we intend to roll out on the 15th of June. But, if anyone wants to talk about the basic market as well, I was on CNA this morning talking about some of the recent strength we've seen in our Singapore stocks. There is obviously there's always been a little bit of cynicism in terms of the moves and the recoveries of the stock market, given we have so much focus on battling COVID, and we're seeing that some of the worst prints in some of the data we've seen for a long, long time. But a key thing that did occur, and this is why I've got this slide up, a key thing that I think has been overlooked somewhat was back in March, back in that third week of March. The Fed Reserve moved so quickly to shore up liquidity with the US dollar. You can see this dollar index. This first chart here is the US dollar index. It went nuts up to 104 in such a short period of time. And you remember that's when the Fed Reserve and the MAS, they opened up swap lines with US dollar and Sing dollar and so forth. The Fed moved very quickly to cut the rates, and we saw this volatility of the US dollar back off somewhat significantly. So currently, more than the economic data, a lot of our big markets are taking their cues from the US dollar, as well as the 10-year yields and the rest of the US Treasuries in the US. And they have been in a very tight range in May particularly, and somewhat in April. And then that's continued in the first week of this year. So these Treasuries have stayed in a very tight range at lows around the 0.7 level. We've seen a lot more of the volatility just come off ridiculous highs in the US dollar, and that has provided some cues of stability for our global equity markets. But the key thing is, of course, exactly what Jerome Powell says, is that these prints for this quarter will be amongst the worst, even worse than last. I mean, unemployment's out tomorrow night, and we're expecting that to rise to 20% tomorrow night, up from 15% the previous month. James Bullard, the Fed Reserve president for St. Louis, he said, they all believe that it can come back below 10% by the end of the year, and the US can recover, but as long as it does avoid a second wave of the coronavirus. So even though we've had the moves, we are not out of the woods yet by any means. The key thing is these lockdowns have to work, and especially for the US, it has to avoid a second wave of the coronavirus. But there, as you can see, we've also had that recovery in the SiMSCI, which is in the top left here, which has brought us to this level here. So I'll finish here. We've got 8 minutes or so left. I'll finish here for some questions, and thank you for our listeners and our attendees tonight for being with us. So if there's any questions, please let me know, Huai-Cha.
Yep. Okay, so our first question for tonight is, why does the SiMSCI have a strong correlation with crude oil?
I think it's basically, it's not just the SiMSCI, it's Singapore. We get, if we went down to NUS or SMU and I said we've got a strong correlation, they would laugh at me because 70% is not, it doesn't get a T-score, it's not statistically significant, but it is there because we are a huge logistics and trade hub for the region. We know the banking exposure to the oil sector. Being a small red dot, a small island, means we are so trade related, and crude oil is such a proxy for the state of trade, whether especially from a demand perspective. Like I said, we're 0.4% of the world's GDP, but of the total trade value of exports and imports all across the world, we are something like 1.6. We have 4 times the impact in that part of the world, and hence having that exposure or that sensitivity to global trade, it does resonate somewhat or get played out with the price of oil on our market. So even though we don't have a big energy sector in the index or oil and gas sector, even though our most traded stock is Rex International, which is a catalyst stock, a lot of the customers or a lot of the tenants of the real estate, a lot of the customers of the banks and the professional services have some kind of link or chain to the maritime and support services for oil and gas. So yeah, it is pretty important. We are remember also a Southeast Asia hub for logistics, for finance, for transportation, and hence and that hub status of Singapore, it's sustained somewhat, not just because we're great exporters with our ASEAN neighbours, we're also massive importers from our ASEAN neighbours, the big importer as well. So that makes us that hub that has, I guess, the sensitivity to the price of oil somewhat.
Okay, and we have someone who wants to know, like, in your opinion, what's the support and resistance level of STI?
Oh wow, that's a technical trader. You know, there are so many brains at that Phillip Futures and the Phillip Capital and even Phillip Securities that could answer that question better. For me, the key level I was looking at was that previous high of 20. I think it was 2671 thereabouts for the STI. We basically formed a new high from the major low. So clearly the major low on the STI is 2208. That was on the 23rd of March. But for the I guess for on the upside, it's basically yes. Today's high is the new kind of interim high per se. But again, you know, I'm not a technical analyst anymore, but I do know the rules that you know, old support can become resistance and so forth, and of course, key figures, key numbers matter. You know, I mean, you know, the key levels like 2800, 2900, 3000, and so forth. They're all important, but as I say, yeah, I know there are a lot more brains and a lot more expertise at Phillip who can answer those questions better. I mean, I know that because I see some of the reports and talk to a lot of the brokers at Phillip who are very well versed in support and resistance.
Okay, so the next question is, how significant is Nikkei to that of SGX? Are they very closely correlated?
You know, let me just try. Let me just try and bring it up on Bloomberg, okay? Bear with me because I am a little bit of a tech Luddite, but it's a really good question, and I'm going to try and do this. I'm succeeding so forth. So if you please just give me if you give me one more 30 seconds. I can show you. Okay. So hopefully, Hui Cha, can you please see this chart here? Can you see have I changed? Have I got live prices?
We're still looking at your slides.
Oh no. Okay. Bear with me. I'm going to show you one of these Bloomberg screens, but I don't know which one. Okay, is this Bloomberg 1? No. It's Bloomberg 2. I think I've done it. Have I done it? Can you see QZ1 index and NI1 index?
Yep, that's what we're seeing.
Well, here they are. This is over the past 12 months. So the white line is the MSCI Singapore Futures, and the orange line is the Nikkei Futures. So there is some correlation there significantly. But as you can see, we've also traded recently at a little bit of a low. So we are beyond 2 standard deviations of the Nikkei. So you can see there is directional correlation there. But it's with this green area coming down, it's just basically showing you the Nifty, the SiMSCI futures have not been keeping pace with the Nikkei futures. So the Nikkei has been outpacing us. It's got to a point that it's got to its lowest point at the end of last month, at the end of May, and it's since coming back a bit. Obviously, it's come back a bit. I mean, you know, we had an incredible 3 days this week. You know, I was going through all the indices I could find on Bloomberg, you know, 200 global indices for those 3 days, and the 9% gains we made were strongest in the world, bar one country, Argentina, that was basically also generated a similar return. So anyway, point is that, yeah, that you can apply this type of trading to these two contracts. There will be a margin offset as well that you can find, and this is basically doing is showing you daily prices, which is the white line, the SiMSCI, and the orange line is the Nikkei, and there is a little bit of a 20% divide somewhat over the 12 months, and you can see that it's starting to come back somewhat from below 2 standard deviations, but it's still not broken above 2 standard deviations yet, so it's possibly not mean reverting. One risk is you can get down to this 2 standard deviation below and it can stay there for a long time, and maybe technical traders there that use the likes of MACDs or stochastics and George Lane stochastics and so forth would know how that works.
Yep. Okay. I think that's all for the day. Yeah. Thank you very much for your time today, Geoff. We will be sending everyone. Sorry.
Yeah, and sorry, wait, Geoff, I could just say thank you so much for being with me for the last hour or so and staying on the line. And yeah, obviously you can contact Philip for more information, but I supposedly do have a reputation for being very approachable. So please feel free to shout out if you need me. No problems. Okay, and I can always point you to the right people at SGX that might be able to help with some of the questions, and point you back to some of the great people at Philip as well who can answer the questions just as well. Thanks.
All right. We will be sending everyone a link to today's webinar so you can watch it again if you'd like to. That's all for today. Thank you, everyone, and goodbye.